again, thank you everybody for joining today. We're going to wait one more minute and then we'll get started. Thank you again. Okay, I think it's time for us to start. Thank you everyone for joining today. My name is Frank McLaughlin. This is the first time we're using Zoom, so it's kind of weird seeing myself present to myself, but nice to meet all of you. And I am joined today by Deanna Alton. She is a director of our BTAG department, which is our consulting group. Deanna has been with us for many years and is a shining star in the firm. She's going to be talking to a little bit about some different things today, while I'm going to focus primarily on PPP and ERTC, which is what you've kind of heard me discuss at length in the past. But to kind of set the stage, the American Rescue Plan Act was signed by President Biden, and it is really focused more around, and what you're seeing is kind of a waning of direct stimulus. Well, I believe it to be a direct stimulus to businesses and more to personal and helping individuals out. That was more the American Rescue Plan from that perspective. But there were some really nice tidbits in this plan. You know, there was the restaurant revitalization grant, which Deanna will talk about today, and as well as you know, shuttered venues and those grants. So there was some definite things, but they're being a lot more direct and pointed in where that money is going. Before, I think, especially when we first started this journey, it was a big wide net. And now that you can see that net is really shrinking down to a fishing line in terms of what businesses can and cannot or eligible for these types of things. So, and even going further from that point of view, as long as everything stays in the positive and the numbers continue to trend in the right direction, you know, as you look into the future of what the Biden administration wants to do, you're seeing the $3 trillion potential package that they want to do. But that's really based on, you know, infrastructure and what they want to do from that perspective. Now, there will be some direct, or I should say indirect, impacts to businesses when it comes to paid family leave or 401k plans and the like from that perspective. But, you know, again, waning away from businesses and more towards individuals and states and infrastructure. So we'll see how that trend continues, but that's kind of where we are right now. Can you go to the next slide, Deanna? So what we're going to talk about a little bit, Deanna will talk about help for individuals. I do think it's nice for you as the employers to understand how the employees could be benefited from what just happened. COBRA and paid sick leave, you know, some of the extensions on that and some of the impacts on your business. The restaurant revitalization grant and how is that calculated. And I believe that you'll notice how it is really trying to go after really disadvantaged locations and businesses once you start putting that together. And then again, I'll follow up with PPP and ERTC. Not a lot changed, but I will try to share with you some of our learnings over the last, year now, because it's been a year. So thank you, and I will turn it over to Deanna.
All right, thank you everyone for joining us today. I'm going to jump in here and we'll talk about some help for individuals. So first thing we'll talk about is the individual recovery rebate, or, you know, also known as a stimulus payment. That's what you'll hear called a lot. So there's a provision in this plan for a recovery rebate credit, an amount of $1,400 for individuals, $2,800 if it's married filing joint. And there's also $1,400 for each dependent. It did expand dependents to include college age students. disabled adult children, and adult parents. They now qualify for that $1,400 dependent payment as well. Payment will be made to the taxpayer and not to the dependent. You don't need to do anything to get the payment, just with the other ones in the past. Most of them were directly deposited, or you'll get a check in the mail. They did change the phase out a little bit. It's starting phase out at $75,000 for individuals, and it's completely phased out once you get an AGI of $80,000. $112,500 for head of household, completely phased out at $120,000, and then $150,000 married filing joint, completely phased out at $160,000. So they did change that a little bit. It phases out a lot quicker than it did before with the other stimulus payments. They also updated the child tax credit. It's increasing from $2,000 for children under 17 to now it's $3,000 per child under the age of 18. If you have a child under 6, it's $3,600 for that child. It begins phasing out at same dollar amounts as the rebate recovery, $75,000 for individual, $112,500 for head of household, and $150,000 for married filing joint. It's reduced $50 for every $1,000 that you're over that phase out limit until it's completely phased out. There is an advance payment option for this provision where you can receive that additional child tax credit on a monthly basis. This is completely new. There's going to be more guidance that's going to come out on that. There is an option to opt out if you don't want to receive it monthly, but they really don't even know how they're going to do it. It may be monthly, it may be bi-monthly, depending on what the IRS can do. So more guidance will come out on that. The advance payments wouldn't start until about July 2021. So more time on that for them to come out with how they're going to work this advance payment option. But there you have it. That's what the plan calls for. Few other provisions in this plan. There's some unemployment benefits. First $10,200 of unemployment received in 2020 is tax-free if your AGI is $150,000 or less. Nothing you need to do on that if you've already filed a return. They're saying don't file an amended return. They're going to try to fix it themselves. We'll see how that goes, but that's how it is if you received unemployment. First $10,200 of it was tax-free for AGIs 150 or less. Earned income tax credit has been expanded. It's been expanded to include children, those with no qualifying children. The minimum age to claim the credit has been reduced to 19 years old, and the credit percentage increased from 7.65% to 15.3%. And so the credit goes from $543 to $1,502. That's just qualifying for those with no qualifying children for the earned income tax credit. Student loan discharge. If you have any student loan debt that's discharged after December 31st, 2020 or before January 1st, 2026, or essentially tax years 2021 through 2025, it's going to be not taxable to you if it's discharged. You'll get no cancellation of debt income on that money if that happens. So just be on the lookout for that. I'm pretty sure there's going to be more things to come with student loans in the future, but that's just kind of laying the groundwork for some of what they'll do in the future. They did relax the premium tax credit. That's a credit you receive if you're getting health care from the marketplace. They have new percentage tables for that premium tax credit. It allows for a higher tax credit, and now more people can qualify because they relaxed that, where before you could not qualify it if you made more than 400% of the federal poverty level. So they did relax that, where now people that make more than that can still qualify and receive some of the credit. So now that was just some individual updates. Now we'll talk a little bit about COBRA and the paid sick and family leave. So the COBRA subsidies, COBRA, the act provided for individuals that are receiving COBRA, eligible to receive COBRA, and maintain their coverage without having to pay a portion of the premiums. So they get 100% subsidy from April 1st to September 30th, 2021. That means they don't have to pay for any of the premiums. The employee does not pay for any of that. This does not extend their time to receive COBRA. It just says that if they're receiving it from April 1st through September 30th, that they do not have to contribute to any of the premiums. For example, if your normal COBRA period would end on 6/30, they would get the coverage, the subsidy from April 1st to June 30th, and that's it. They would still end at the same time they would normally end before this happens. So employers, you are going to be qualified, you're going to be required to notify individuals of their right to receive the subsidy during this time frame. And you're going to have a second requirement to notify them when their subsidy period ends. So we need to take note of that and make sure that's going to be your requirement. If they pay you for it during this time frame and they're qualified for the 100% subsidy, you will have to reimburse them. So it's going to be very important to know who qualifies and make sure you let them notify them that they qualify. And the 100% subsidy, it's not taxable to the individual. They are saying that there's going to be some sample notifications that are going to come out that are going to be issued that you can use when notifying employees that they qualify or when their period ends. Paying for the subsidy. So who's going to pay for the subsidy? So the subsidy is going to be paid for by the party that normally pays for the premium. So if you have a fully insured plan, it's going to be the carrier that's going to pay for it. If you have a self-insured plan, then the employer is going to be responsible for paying for the subsidy. If it's a multi-employer plan, then the plan is going to pay for the subsidy. So there is a FICA tax credit that the responsible party, whoever is paying for this subsidy, can get a credit to reimburse, to be refunded for that additional subsidy that they're having to pay for. And that credit will include admin fees that's going to be associated with the subsidy. So they'll get that back through a FICA tax credit. So it's going to be really important for you to work with your plan administrator to identify who qualifies for the credit and letting them know and following through with all the notifications that's going to be required for you to take care of to make sure you're staying within the guidelines on what needs to be done here. So paid sick and family leave credits. So these are basically the same credits that we've had before, just a few updates. It's still not mandatory that you offer this through 2021, but if you have elected to do so, then it has been extended through September 30th, 2021. The credit, as before, it's a refundable payroll tax credit. They did increase the wages that you can pay for from $10,000 to $12,000 per employee. The credit can be used for, same as before, sick time. If someone is sick, employee is actually sick, or if they're caring for someone who is sick. They've expanded it though to include time off for waiting on a COVID test result, or if you've been exposed and you have to go get tested and you're waiting for your results, it's expanded to include that time. And it's also been expanded to include time off for getting the vaccine or recovering from any side effects of the vaccine. Another thing to know that they updated is they reset the 10-day limit. So before you had 10 days where you can claim this, employee had 10 days. That ended as of March 31st. If the same employee, even if they took their 10 days in either 2020 or first quarter of 2021, they can again get that 10-day limit after April 1st through September 30th. So they reset that time limit for the employees. Again, it's not mandatory for 2021, but if you're opting to do it, you should know that the rules have been updated and this is what it's expanded to include. So now we're going to talk a little bit about the Restaurant Revitalization Grant. So here's a basic recap of what the Restaurant Revitalization Fund is. It's $28.6 billion. You must have fewer than 21 locations. There's a 10 million cap per organization, or 5 million cap per location. There are affiliation rules with this. So it's not going to be done. It's not going to be looked at by entity. It's going to be looked at by an organization. The allowable expenses are similar to PPP 2.0. And I've got another slide a little further down. It's going to kind of go over the expenses and compare them to what qualifies for this versus what qualifies for PPP 2.0 or what qualifies for both. So who's going to benefit? Who's eligible? Restaurants, caterers, bars, saloons, food trucks, brew pubs, tasting rooms, business in an airport terminal. These are businesses that are qualified that could benefit from this fund. Who's not eligible? Publicly traded companies, restaurants that have more than 20 locations, again, together with an affiliated business. This is not by entity, it's going to be by organization. And companies, anybody that applied for the Shuttered Venue Operator Grant. So that was a grant that was signed in December. That was aimed at music venues, theaters, cinemas. If you apply for that grant, then you're not eligible for the Restaurant Revitalization Grant as well. So there's been limited guidance. They've signed this, and there's limited guidance on it. More guidance will come out, but essentially, how much can your grant be? It's going to be computed as your pandemic-related revenue loss. And this is the formula so far that they've come out and said is going to be used. So it's going to be your 2019 gross receipts, less your 2020 gross receipts, again, less any PPP funds received. Currently, it just says PPP funds received, doesn't make any distinction between forgiven, not forgiven. It just says PPP funds received at this time. So, you're looking at this, you're thinking about, okay, whether or not you qualify. Here's exactly how they're going to compute it as we know now. So basically, this is going to be more for people that are really disadvantaged. Their 20 growth, because your 2020 gross receipts have to be less than your 2019 for you to even begin to qualify. It's a grant. It's not going to be taxable to the recipient because it is a grant. How can you use the funds? So you've got funds here on the left here. You've got expenses that are specific to the Restaurant Revitalization Grant and debt obligations that to suppliers incurred before the covered period, normal food and beverage inventory. All the way on the right, you've got expenses that are specific to the PPP 2.0. You've got interest payment on any other debt obligation incurred prior to September 15th, refinancing and EIDL property damage costs related to public disturbances during 2020. And in the middle here, you have expenses that qualify for both. Your normal, your payroll, your rent, mortgage interest, operational expenses, maintenance, utilities, protective equipment, and some previous debt obligations. So that's how you can use these funds and how they differentiate between PPP 2.0 and this Restaurant Revitalization Fund. So what's next? So this Restaurant Revitalization Fund, it was just signed into law on March 11th. In April of 2020, the SBA is supposed to release some rules and applications. So like I said, more guidance is going to come out on this. This is just the very beginning of what we have for this. And in May or June, they're first going to open it up. There's a 21-day period, priority period, that's going to be open just for women, veterans, and socially and economically disadvantaged applicants. That's going to be the first for that first 21-day period. After that, then it's going to open up for all eligible restaurants. So like I said, here's the outline of what the fund is, who qualifies for it. We're going to get more information probably next month about how to apply for it and more rules and more guidance on this as it comes about. So next, I'm going to turn it over to Frank, and he's going to talk about PPP and ERTC.
Thanks, Deanna, and appreciate it. There were some questions that came in that I answered on PPP funds, and then also, Deanna, if you want to look, there was a question for the COVID-19 vaccine PTO. How many hours? 8 hours? Is this ×2 for both shots? Is there anything out there from a guidance perspective on the amount of time, or is it pretty vague?
Can you repeat that a little bit? I didn't hear you at the very beginning.
Oh, for the COVID-19 vaccine. So somebody gets their vaccine shot. It's ×2. How much is that for? Is that for the whole day or for a specific amount of time, or is it pretty vague as long as it's reasonable?
It's pretty vague. It's just time off to go get the vaccine, whether it's the first shot, the second shot. It's all limited to 10 days. It's all limited to 80 hours or 10 days, essentially, is what it says right now. There's no more specific guidance than that.
Okay, thank you. So let's talk about PPP funds. In the new bill, ARPA, they increased $7.25 billion in PPP funds, and the deadline still does remain March 31st, but there is over $130 billion not used to date. So I don't know about you, but I highly doubt in the next 8 days, we're going to use $130 billion on this. So we anticipate that they'll extend it. We don't know if they're going to change anything, or like they did with PPP 1.0, where they had a lot of money left over, they kind of brought it back into the treasury. So we don't know how they're going to handle that, but there's a couple additional dollars. And if you are going to go for PPP 2.0, right now, time is ticking. And I know some banks put a hard lock and hard stop date on when they were accepting applications. So make sure that you're working with your bank to understand that you can still go apply for it. Next slide. PPP and strategy. So, and I'll talk about ERTC in the next slide, but PPP and ERTC are now playing a little bit of a dance together so that you can maximize the dollars. And we'll talk about that in a second, but really there's two types of things that happen here with the PPP strategy. With the change in December to allow supplier costs to be a part of eligible non-payroll expenses for both over $2 million loans and for all loans, right? Now, should we change up? Is that a better use to use food and paper and your Martin Brower bill or your Cisco bill or whatever your major provider is, instead of using rent? And the reason for that is what we've seen is that when using rent, they want a lot more information. They want the lease agreements. They want to know that you were a franchisee for a certain period of time, all of these things. So sometimes with just being able to provide an invoice, and with food and paper being typically more than rent in a lot of situations, being able to use those funds and expenses to maximize the total dollar amount may make it worth it. When it comes to over $2 million loans, we have to supply the questionnaire, and the questionnaire asks certain questions. What were your distributions? What loans did you pay off? What did you buy? What did you reinvest in your business? And what they care about is the covered period, right? 8 weeks, 24 weeks. And as long as everything is copacetic and there's nothing really crazy going on, the 24-week period is still the right, strategy from that perspective, and using, all payroll would be the right strategy as well, as long as you're not over that 100 FTE mark for ERTC. We'll talk about that in a second. But if I trim up my covered period to 8 weeks, now they only want to look at my 8-week period, my general ledger and my distributions for 8 weeks, what I purchased in 8 weeks, what I did in 8 weeks instead of 24 weeks. So depending on your specific situation and talking to your advisor, you may want to think about readjusting your strategy for PPP 1.0 and 2.0 and your forgiveness application. Now, I've been asked this question. If you've already filed your application and you haven't heard anything, no, you can't go back and do that. Once you filed your forgiveness application, you're locked into the rules at that time. So that's this kind of, unfortunately, revisionist history that I wish we could go back and say we knew what we were doing this entire time. But, you know, through the last year, that hasn't always been our friend. So everyone else is good, but if you haven't, you know, maybe want to relook at that and see if there's a strategy, talk with your advisors through that, okay? And just a quick side note on that. Yes, there has been a severe, the SBA slowed down significantly in getting those out. We don't know why that is. We don't know if that is because they wanted to get PPP 2.0s out first and then go back to PPP 1.0. So just realize that there has been a slow down in getting back through the forgiveness process and getting that forgiveness. When it comes to ERTC, right? And if you did not apply for forgiveness again, well, and you have an under $2 million loan, but you can get ERTC and you have that under 100 FTEs, full-time employees, you know, maybe we want to go back and use supplier costs, food, paper, operating supplies, and payroll. So now, because remember, and this will be on the next page, sorry, you can't double dip. You can't get a credit for PPP dollars on payroll and get your ERTC dollars. So if we can kind of go backwards and reduce the PPP dollars and put more non-payroll expenses onto our forgiveness, well, now I've opened up more payroll dollars for ERTC. Again, a strategy and playing with both ERTC and PPP. Another nice little thing that came out with guidance is that the payroll dollars on your PPP. So I know a lot of clients out there and a lot of restaurateurs that went 100% payroll. And let's just say your loan was $1 million. But your payroll through that period was $3 million. There was a concern that all $3 million would be restricted from ERTC. It's not the case. Only the amount up to the loan value of those payroll dollars are restricted. So instead of backing off everything you've put on the PPP loan application, you're only backing off the $1 million of the actual loan amount that you're going to get forgiven. So that is a nice little play, and it really helps with strategy to maximize ERTC in 2020 and 2021 if you got PPP 2.0. Couple other things on PPP. And this is coming out daily. You know, I'm up here in Massachusetts and they just changed their mind and decided, yeah, no, we're not going to add it back and the deductibility is good. Just because the federal government came out and said that the PPP is not a taxable event does not mean the states have conformed and followed suit with the federal government. Now, a lot of states have, but make sure you understand or talk with your advisors on what states haven't, because, you know, at 5% on $1 million, that's an extra $50,000 in taxes paid to the state that you may or may not be ready to pay for. So understand if your state is doing that. Let me take that a step further with another thing that just happened last week. I'm unsure if you know this, but the filing deadline for federal taxes was just delayed to May 17th. So we don't have to file an extension until May 17th. We still have to make our payments on May 17th. But again, just like last year, remember they pushed it from April 15th to July 15th. Some states still made you pay in April, still made you do something in April. So again, the states have not 100% conformed to that. So be aware on April 15th that, let's just play it out and say the worst case scenario, they want to tax PPP and they want their money on April 15th. Be ready for that, because that's going to be not when you owe and you're going to file your federal returns. So just strategies, game plan wise, there could be some cash outlays before May 17th. Okay. So there's two sidebars that I wanted to bring up. Can we go to ERTC for a second? All right. So ERTC, this was extended. So at first it was to June 30th. Now it's till December 31st. So it's for the entire year. And it remains 70% up to $10,000 per quarter. What does that mean? If you pay someone $10,000 a quarter and you pay them and you were eligible the entire year, you can get up to $28,000 in credits for one employee. Now, this is where it gets complicated. Because why do you qualify for ERTC? Do you qualify? So let's just pretend for a second you qualify because you meet the 500 full-time employees for 21 and the 100 full-time employees for 2020. Do you meet it for sales decreases in the first quarter and the second quarter? Because that you need to meet those sales decreases every quarter. Do you meet it because of the government restrictions? Because if you do, you need to meet that for every quarter. You know, being hopefully a positive guy, I hope that we're not in government restrictions all the way through December, but at the end of the day too, what this allows us to do is if we have another spike, let's just say at Thanksgiving like we did last year, restrictions do come into place, well, then we can recapture some ERTC credits at that time. This becomes really important because we are no longer beholden to dates. It's about what the governor decides to do with my state. Look at Texas. Texas and Mississippi, I think in the beginning of March just said, nope, we're open for business. At that moment, and this is something we've gotten guidance on with the ERTC, at that moment, that person, if you qualify for government restrictions, you no longer will get any wages past when that restriction was released, right? So will you still get it from January 1st to when Texas opened it? I think it was like the 5th of March. Yes, but everything past that, you no longer, those wages no longer qualify for ERTC. This is important because if you're using some companies out there that are doing 7200s on a weekly, bi-weekly basis, well, if they didn't make the adjustment on the fly, right, then you could be holding back money and getting money from 7200s that later you may need to pay back because you didn't meet the mandate through that period of time. I guess what I'm trying to say is you have to be on top of your mandates and understand when you qualify and when you don't qualify, because you could find yourself, and now I'm hoping this is just money moving around, but I don't want anyone to be surprised either, okay? So just kind of realize, hey, be on top of your mandates and why that works and what's happening with, if it's your payroll company or credit provider, so that you understand what credits you do get and don't get. And that works on the flip side too. In my previous example of, let's just say November again comes around and we go back into restriction mode. I hope not, but you have to get back with that company and say, no, I now deserve, or I'm now eligible again for that credit. So make sure that you're on top of that to get that eligibility going, to get those dollars into your pocket. The one thing that I do know is no matter what you're doing and how you're doing it, you want to file your return on time. You know, we're seeing that if you file the 7200 and file your 941 on time, you're getting that money back, give or take 6 weeks. You do an amended return, give or take 7-8 months. So, you know, it's a little bit of a time expanded when you have to amend a return to get your ERTC dollars back to you. Again, I just want to talk about this. You can't double dip with PPP 1.0 and 2.0. Documentation is key on that, especially if you have multiple entities and one entity does deserve or was eligible for PPP 2.0 and got it. You need to make sure you carve out those dollars and you're not getting any ERTC for those payroll dollars. And if you have a roll-up company, well, that's going to get even more complicated with what you can and who you can get it for. So just make sure you're lockstep with what that means and what that doesn't mean. This is a big difference from PPP and the Restaurant Revitalization Act. ERTC credits are a taxable event. Essentially, what you're getting is you're getting funds for your wages. So if you had $100,000 of wages and you get $70,000 back, the way the IRS looks at that is you only 100 minus 70 equals $30,000 in expenses. So you're increasing your taxable income by that 70%. So any dollars you do receive, you know, at whatever rate your taxable income is, that needs to be put to the side because it will be a taxable event. And then again, make sure your documentation is placed because they extended the look back or audit period, if you will, when they can review your information from 4 years to 5 years. So 5 years up until when you file it, they can look back at any time and go look at it. I have a couple of questions here on this. What about local mandates? Yeah, so this is where it gets, really quite critical to understand what your mandates are. Just because your state doesn't have a mandate does not mean that you don't have a mandate. And I always will go to like the major hubs and cities. New York City. If New York City continues to have its mandate, well, then your business, because of the rules, you are partially governmentally restricted. So that one restaurant or two restaurants that are still restricted makes you eligible for all of those locations, or LA County and the like. So yes, but you have to make sure you have documentation to support that and back that up through that process, okay? So our credit's available for the time of restriction, even if it's not for a full quarter. That's 100% correct. So, and if I read it right, you are only, I'll try to summarize. If you're eligible for restrictions, you are only eligible for the wages you paid during the restriction period. So, for example, Texas, right? I think it's the 5th. From January 1st to March 5th, that payroll of March 5th, you're eligible to get ERTC on all of those wages. But if you have no restrictions on March 5th going forward, those wages no longer count. So you can still do your ERTC, get it for that first, just over 2 months, but you won't get it for the period that you weren't restricted. Okay, I hope that helps. So that's what I have on ERTC. Again, it is a documentation, making sure you understand what's going on, make sure your restrictions are locked and loaded, and that you have the documentation to support yourself. You have those things. This is very different from PPP. You don't need to show that, and it sounds weird, but you don't need to certify that you need this money. You don't need to go through a questionnaire. It's you meet the requirements, you get the credit. So make sure you meet the requirements, and you really, at that point, you're free and clear. You just have to make sure you meet the requirements. Okay, so that's it. That's what's wrapping up. I think if anyone has any other questions, I'd love to answer them for you. Deanna, myself, any questions out there? I think I kind of answered the ones on the fly. Again, everybody's situation is different. Please reach out to Deanna or myself, and we'll be happy to help you along with your situation. Thank you so much, and have a wonderful day and week.
Thank you all for joining us.